Hey everybody, this is Jose. We are about to get started. This is a sound check. As always, before we start our session, please go ahead and type a quick message on the chat box so I know that you hear me. I know that sound is good and we are ready to get started on time. I'm getting the sound okay on my end. Please confirm it's the same on your end so we can get started. Thank you so much. We got 20 seconds to go. So almost there. Thank you so much. Hi, Christian. No problem, my friend. I see you. Sound is good. Thank you for confirming. Thank you so much. Very good. That's it. Top of the hour. Let's get started, everybody. Welcome to the session. This is January 27, 2022. Jose Blasco here. Options with Options is the name of our session. A session where we look at the options markets. I guess it's self-explanatory. We look for options opportunities. We apply trading rules. We discuss trading technology, trading plans, trading methodologies, and risk management, and everything above and beyond. In any case, before we get started, a disclaimer, please read it carefully. It's fairly short. It's very important. So please, I'm counting on you to read it completely. And as we do that, we will be ready to move into the session right now. Here we go. Perfect. Okay, so agenda for today. We're going to be looking at the market. We're going to be reviewing trades that we have and discuss if there is anything we can do to such trades. And from there, we'll move into looking for new opportunities, new trades, and putting that together. Okay, so let's begin by closing this window, getting into top. Actually, before I get into top, a quick reminder here of our question page. In my specific case, I will pop the URL on the screen so you can see it. tradewithufos.com/Jose. If you have any question, well, you could certainly email us and you are more than welcome to do so. Recommendation, and also because it's a community thing, would be to come to this page, okay, and click on the purple box so you can log in, then click on the green box. So now you can ask questions, including uploading files, pictures of your charts, etc. And by the way, before you even ask, a good recommendation here is to type your question in the search box, because maybe the same question was asked already in the past and the answer is right there waiting for you already. So you can actually search, because obviously this list is growing little by little through time, and there is lots of materials here that are indeed quite advanced. Okay, so keep that in mind, as this could certainly help you. How are you, Mark? Good to see you. Very nice, everybody. Okay, so with all of this said, let's move into the platform and let's begin our market analysis. Good, perfect. Okay, so where are we at? Well, powerful market pushing down, isn't it? We talked about it last week. We already had last week a climate that was surpassing number 2, which is the statistical duration of this climate in a one standard deviation of the cases. We are now dealing with a situation which is 9 candles when statistics which have suggested 2. So this is indeed a climate that, statistically speaking, has been spending too much time moving down. So odds are, believe it or not, for the market to reverse, even though, of course, when you see these huge moves, these huge gaps down and everything else, most people, people that are probably not properly educated in trading, on their look at the markets with a huge emotional aspect of their opinion on market analysis. But, what we do here, especially with technology, is forget about emotions, forget about the human side, and basically we rely on what computers do better than humans, which is to process data, in this case stats. And statistics, obviously, they may be met, they may not be met, they tend to be met more often than not. That's why they're statistics, isn't it? But in this case, they are not met at all, since statistics were suggesting a climate moving to the downside and last for 2 candles, and we are already in that climate for 9. Okay, so very extended market. Plus, on top of that, this is not a joke movement, to be honest. It's obviously not the end of the world. It's not a 50% correction. But indeed, it's a powerful move, because also when it comes to max distance, okay, we have reached levels up to 2.3, where 2 standard deviations in this case, not 1 standard deviation, but 2 standard deviations in this case, we have suggested that 0.98 is when we have now market data that basically can be translated or interpreted as too far, too fast. So the market went like more than double the too far too fast definition based on a two-standard deviation, which is a huge move. Okay, really, really impressive. Not only because of the duration, but also because of the magnitude. Okay, so obviously we have some positions in the portfolio that were directional long. Obviously, those positions are not doing too well, so we're going to be looking at what can we do there. Also, we had other type of positions where other implications take place with increase of volatility or other aspects. We're going to be addressing all of that. Okay, so feel free to ask questions during the session if you have any question to ask. Indeed, when it comes to planning trades, well, obviously the climate is down, so we cannot not respect that. But at the same time, 9 out of 2 implies that now betting now on short moves, okay, it's what statistically speaking would be defined as too late to the party. So we want to be very careful if you're going to be entering either longs or shorts. Definitely, you want to hedge immediately, and obviously in that market condition where the climate is supposed to change, right? Even if it's going to change only for a while or whatever happens, we are dealing with also a very high inflation environment at this moment in time. Therefore, non-directional trades are the preferred type of trades to be put in place at this moment in time. Okay, so we'll be dealing with that. From a UFO point of view, there is no UFO anywhere close by, either above or below. Okay, for me to see the one below, I will need to load more data, really. So there are some UFOs below. Some of the UFOs that were present acted very well. Okay, so if you look at this UFO here, a couple of days ago, price came inside the UFO. All the orders were filled. The UFO was removed from the screen, but all these buy orders remove all the sellers, and here we go. The market went up until it reached the red UFO, came back down into a new green UFO, and the market went higher again out of that UFO. So definitely we can see the buy orders that are added in the market are acting very well, meaning that some large market players are looking at the markets the same way we do, meaning that they are anticipating the market to move higher more than lower, even though it's been moving low very strongly. Right now, at least short term, the bias would be to the upside. Okay, but notice that in recent times, a red UFO took place, and this is where the market hit that red UFO today, and from there it started falling, even though now it's trying to fight it, okay, and come back higher. So again, we will see what the outcome is going to be, but again, based on stats, we should be changing climate, sooner than later. From options volume data point of view, and by the way, I had a chat with Mark the other day, isn't it, Mark? You may be having a smile on your face right now, right? You may have noticed that during a few sessions, Mark was mentioning the fact that his data on the screen was not lining up with my data. So we were both ready to look into, what's the issue, where's the problem, what's the, how can we fix that? And the bottom line is that the problem was actually on my side, where because I often use development versions of the platform because we are always working on functionalities and things like that. So so basically the bug, if you wish, was on my end because I was not using the right version. In any case, this is now working fine. And Mark, feel free to comment. Okay, if I do this and I do this, I believe we should be able to see the same market data at this moment in time. Okay, let me know if that's the case or not, but that should be the case. Yeah, you said it's off again, but that's because I haven't done what I just done. So I believe that it should be fine now. My two-standard deviation down says 1.23, and if that number is different, that's a totally different story. That probably means that you are loading a different amount of data. For me to get those stats, I am loading 300 bars, which is more or less a year plus. Okay, so that's the amount of data I'm loading. If you were to load the same amount of data, you should have the same result. Okay, so you may want to take a look at that. Cool. Okay, so back to where we're going. Okay, back to where we're going. The VIX. So I was saying the implied volatility is quite high. So we are talking about 29.37% at this moment in time. So, volatility, which is quite decent. Going back to SPY, okay, and and going back to SPY, and as I said, ready to begin putting some non-directional trades in the market after all this market analysis. Any question, please feel free to comment, feel free to ask. Second step in our session for today is to review the trades that we have. Okay, one trade is COF, which that one expired last week on January 21st. So this one is a trade that ended up with a profit. So we talked about this trade for a while. So I'm just gonna delete it from the screen because this trade is over and did end up as a profit. So great. Second trade that we have here is Yelp. Okay, Yelp that started not working well initially speaking. So then we went ahead and we're converting this trade, sorry, from a spread into a butterfly. Give me 1 second, guys. Sorry for that. So we converted this trade from a spread into a butterfly, and we are fighting the fact that that stock has been a teaser for a while, but beyond being a teaser now, that stock is not behaving very, very well in our favor. This is the price at which we entered. I call it a little bit of a teaser because it went down and then up and down and up, and then down again. So you would expect it to go back up, but in this case, it went even lower. Okay, so not teasing any longer. It's really moving against us. So far, by butterflying it, we are helping the problem. We got until February 18 to see what's going to happen. Obviously, it's not looking too good. But again, if the climate on the S&P was to change, remember Yelp. Theoretically, at least when we enter the trade, is a stock that belongs to a strong group. So we could see very, very powerful strength kicking in. And next thing you know, as long as we reach 38 or above, we're going to be breaking even and we will indeed exit this trade. We're not going to plan to make money on this trade, given how far it's moved against us. But if there is an opportunity to break even, we're just going to exit, okay? So at this moment in time, nothing to be done. We talked about this trade multiple times. You have 300 bars for AutoClimate. Okay, so one more thing here. When you look at AutoClimate, let me see. Do you have this display max distance? Okay, take a look at that. Yes, of course, Christian. I get your point about the weekly. Definitely. At the same time, again, the fact that on a weekly time frame the market could do something doesn't mean that in a lower time frame, such as daily, you cannot take trades in the opposite direction if the climate on that other time frame does suggest so, right? So again, if you are looking, and I know it's not the case, but I'm just gonna have a generic statement here related to trading. So especially for the newer traders with us, you keep that in mind. So if you were to be looking for a methodology where all time frames confirm the trade action you are about to take, well, basically you would never trade. There is always some sort of a contradiction. If you keep looking at more and more and more time frame, there is a moment in time there is a contradiction, and this is the direct consequence of the fact that we cannot predict the future. Okay, if we were to be able to predict the future, obviously things would align with the time frames, and next thing you know, the daily we confirm the weekly, and the weekly would confirm the 4 hour, and the 4 hours the 10 minutes, and it would be amazing. But it's never like that. So in the end, you have to take action based on your rules, based on your trading plan, which imply the use of a specific set of time frames, whatever that is, knowing that if you keep looking at other time frames, then you'll find contradictory information. But it doesn't matter because even if all the time frames were to be aligned, let's say there is this magic moment where the monthlies, the weeklies, the daily, everything is aligned. Well, you can still lose, right? Because next thing you know, the market may move in the opposite direction. Next thing you know, a few candles later, now you have the contradiction, but not when you enter the trade. So there is no magic setup, perfect anything in trading, and therefore you need to be willing to take action based on your set of rules, which imply a specific set of time frames. Okay, so the sessions, when I run the sessions, I try to be fairly active. I base a lot of the climates based on the daily time frame because if I go weekly, 2-day, 3-day, 4-day climates, things like that, I could. But then the trades are going to be slower. And while that's not a bad thing at all, or maybe actually very good for you, depending on your trading style, it would be, let's say, less supportive from a coaching point of view, because from a coaching point of view, I do try to get as much activity as possible, which is often difficult because we are always combining a little bit of lecture time with trading time, and I cannot have 50 trades an hour, right? So, but at the same time, I want to be a bit more on the active side. It doesn't mean that needs to be your case. Okay, so keep that in mind, and I'm sure you are with me on that. Okay. Okay. Okay, from a standpoint, I always look at the weekly for trading, of course. Yes, of course, I'm with you. So it's absolutely fine, and actually, it's the way to do it. That as a trader, where you have developed a specific methodology, for example, to be active, like a swing trader, for example, then on top of that, now as you are done with your swing trades, you turn around, you change your hat, and now you are an investor. And for that, you may have a different methodology, or the same, but a different set of time frames, or a combination of both, or whatever that is, which is another trading plan, right? And as you change hat, it's like you don't even remember the trades you took, for active purposes, and now you are doing your investment. Okay, so I know, Christian, we are 100% in the same page. Okay, I just wanted to phrase it, especially for new traders that could be with us. So again, it's always important to talk a little bit about trading plans, trading psychology, and all those things, apart from the trades themselves. Okay. Cool. So back to reviewing the trades. So we are looking at Yelp. The next one in line is Lennar Corporation. Okay, so LEN. So that's that stock. Okay, if we look at when we entered that stock. Okay, so I mean we caught it at the very right time, but in the complete opposite direction. Okay, so that stock has been moving absolutely furious in the opposite direction. And in that sense, we are indeed in a problematic situation, right? If I look at the midpoint here, so Lennar is showing minus $215 of loss per contract. So if I was to right click and look at the risk graph, um, the maximum you can lose is 230, and we are currently underwater by 215. So this trade, statistically, it's a trade that it's not going to end up well. Okay, statistically speaking, of course, you can have this, complete turnaround. That could certainly happen. But when you look at how furious and how fast the move has been, then it's difficult. I remember that was a few weeks ago that we tried to help this trade by butterflying it, but it didn't really help because the stock had moved a bit too much against us. There were signs of strength coming into the S&P. So the idea was leave it alone. Hopefully the market will bounce. If it bounces, then we can butterfly it, and then we will be in a totally different position where the risk would have been cut by half of or less. Okay, but I didn't manage to do that, at least during the sessions that we spent together. If you had done it, on that particular day, then yes, when the market came, much closer to where the entry was on that day, probably you could have butterflied it, and now it would not look the way it looks at all, right? So, but I haven't, okay, which is in one hand bad because I could have helped this trade better if I had been watching it, even though I tend to leave these trades alone until next time we meet, so I can do the things with you guys, unless, very, very rare cases I have acted without you. But to be honest, while it's not ideal, I'm actually happy for today because I'm gonna try something else. Okay, something else which is a bit more extreme, which I would normally not try unless we had something like that happen. Okay, so when we entered this trade, the volatility was around 26, 27. Currently, the volatility is 43. That is a massive, massive, massive increase of volatility. Well, that may help us to do something that in most cases will never work. But in a case which is such an extreme, it may help the trade. And let's try. Okay, now here's the rationale. So this trade, first of all, let's review what it was. Okay, so that was a bull put spread where we sold a put and we bought a put. Okay, to be more precise, we sold the 120 put and we bought below the 115 put. Okay? So that is a 500 risk trade, even though this trade doesn't have $500 of risk. because we collected $270 of credit, and therefore the maximum risk was 230. Okay, so that was the original plan. And also important for you to remember that when we did this trade, while it was a bull put spread, that bull put spread was in the money. So it was loaded on deltas, and this trade was really going to work and only going to work if the stock was going to move in our favor. If the stock was going to move against us, it was not a classical application of credit spreads where you sell spreads far away, and because it's far away, you hope, which is a word that I only use as a joke when I'm trading. So a little bit of sense of humor here. So you kind of hope that the stock will not come and catch you, right? Well, that was not the case. In this case, we were indeed directional. Okay, very directional. We just happened to use a credit strategy because it was providing a much healthier return on investment for the trade. Okay, and we went this way. Okay, now when the stock goes against you, like it did in this case, okay, well, in one hand, there is not too much you can do because the stock falls and falls and falls and falls and falls, and therefore you are way below 115. That stock is currently trading at 92, right? And because you're way below 115, well, for sure, the 120 puts will be assigned, and the 115 put will auto-exercise, and therefore you're going to be in at 120, out of 115, you will lose 5, but you made 270, so you will lose 230. That's it, done, end of the story. Okay. The only way this changes is for the stock to rally. So basically, you would be kind of stuck. You would be like, okay, there is not much I can do here. But the one advantage that I'm thinking of, and let's see if this is going to work or not. The one advantage I'm thinking of is the fact that because that stock dropped so much and volatility rise from 20 something to 43, and we still got some time to expiration, which is February 18, the one thing that is happening is that those options, while they are deep, in the money, and therefore the impact of volatility is less because these options, they got very little. They got plenty of delta at this moment in time, so the impact of volatility is a bit less. The reality is that because implied volatility has grown so much, then we may have an impact of implied volatility, which could be a bit more on the significant side. And if that's the case, so what we could do is we could close the 120 for a loss, okay, which is going to be a loss anyway. I mean, it's going to be a loss protected by the 115, okay? What we can do is maybe, okay, we're going to try. I'm not sure it's going to work, but again, because volatility went to 43, there is a chance it's going to work. So you will want, again, let me pause and rewind. You will never try to do what I'm about to do if volatility didn't rise. It would be a complete waste of time. But because volatility has risen so much, so there may be a chance that closing the 120 now, where we are still far away from February 18, may give me an opportunity to exit that put at a loss, but less of a loss that it should be if volatility had remained the same. And then if I do that, you're going to be like, okay, so what's the point? Because now you exit this trade, you took a loss, and now you are in a profit with the 115. Great. But what if from now until February 18 the stock rallies? Now that 115 put is not going to pay you as much. So you're basically left with a naked put, right? Where if the stock keeps falling, that's a very good news. But if the stock rallies now, it's a terrible news. You may end up losing way more than 230. So why would I do that? Well, the reason why I would do that is because my second step would not be to leave the 115 alone. My second step would be to now sell a put below, converting what was a credit spread known as a bull put into a debit spread known as a bear put, meaning that now I'm going to be locking in $5 of profit from 115 to 110 and collecting some credit from the 110, which, by the way, the credit, it's inflated. So that may actually already improve my P&L. And additionally, as a step 3, what I want to explore as well is what if on top of doing that, okay, what if on top of doing that, I turn around and I sell a 110 call and I buy a 105 call, where if you think about what that is now, okay, buy the 105, sell the 110 call, sell the 110 put, and you already have the 110, 115 put. Well, that's one of our friends, the butterfly, isn't it? So again, this would be a complete waste of time if volatility didn't rally. But given the fact that volatility has risen so much, I'm going to give it two shots. Shot number one, which is to sell the 110 put and see what happens. Shot number two, to also add the call side to butterfly it. And I may end up myself in a position where my max risk may be diminished, and I may be giving the trade a second chance to make some profit further down from 117, because right now my break even, as you can see, is 117.30 right there. And based on statistics, the stock will not rally above the purple area. I mean, again, this is just a one standard deviation of price movement, so it could indeed go higher. But again, 117 feels quite high. So if I do something like that and I butterfly it, I may end up with some sort of, a triangular shape type of risk profile around the 110, meaning that now my break-even point may be somewhere around the 107 area, 107 area, or something like that. We'll see, because it all depends on how much premium I'm going to get. And that would create, again, a second opportunity for the trade while I diminish the risk. Again, one last time, this would never work unless volatility has risen, and it has risen by a lot. So let's give it a try and see what happens, okay? Yeah, looking at the comments there. Great. So let's go ahead and use our function compare spread to do that. So I'm going to copy the primary spread, okay? And the first thing I'm going to analyze is, okay, so what if I buy back the February 120 put at current price, which is the midpoint, which, by the way, we're going to have to be careful with that because the spreads are getting wider, okay? So $1 spread almost, because this option is so deep in the money that obviously the delta, the very high delta, implies the option is very deep in the money, and therefore this could be a problem. Okay, so again, what happens if I close the trade now? Well, if I close the trade now, I lock in my profit of 215, and if the stock falls, now I can make an infinity amount of capital. But if the stock rallies, I could lose all the way to over $2,000, right? Which is what I said. If I close the 120 put and the stock rallies, it could be a very, very big problem. Okay, so I don't want that. I'm not going to do this, and that's it. I'm going to go ahead and, on top of closing the 120 put, I am going to be selling the 110, which is closer to the current price, converting this trade into another type of trade and see if that helps or it doesn't. Okay. Well, by doing that, I am basically collecting $17.40, which is a nice amount of premium. Okay. This basically, if the stock stays where it is, okay, let me bring some additional analytics here. So if the stock stays where it is, so I am achieving the goal of going from an initial risk of 230 to a new risk of 205. So I am lowering the risk by $25 per contract. So that's good. But careful, if the stock rallies too much, above 110, I am now risking up to $700. So that is not good. Okay, it's not good, meaning that, I help the trade a little bit. If the stock remains more or less where we are, it's fine. But if the stock rallies, we can be in trouble for more than 230, which is $700 of risk. So not happy with that. And therefore, the only way to accept this trade then is that I need to add step 2, the call side, and let's see what's going to happen. Not sure it will work, as I said, only in those exceptional conditions of high volatility, this would help, which, as I said, is not always the case. Okay, so how are we going to do this? Well, I'm going to sell another 110, but in this case, it's going to be the call. And then I'm going to be buying a 105 call. Okay, so by doing that, if you ignore the 120 is there, sorry, not like this. If you ignore the 120 is here, because we sold it and we bought it back, so it's gone. So now you are left with buy the 105 call, sell the 110 put as well, and buy the 115 put above, which is the butterfly, right? So let's click OK and see what do we have if we do this. And this risk profile makes absolutely no sense. So what did just happen there? Let me review. Oh, yes, those, for whatever reason, when I clicked somewhere else or something. So we're going to be selling the 110 call and buying the 105. Here we go. So 110, 105, yes. Okay, yes, correct. Here we go. So this is what we are now achieving, okay? Which is not good enough. It's a shame, but it's not good enough. Just by a little bit. So notice how, where we are risking 230, okay, where we are risking 230, now the most we risk is 242.5. So we are actually increasing the risk by 42.5 dollars. Sorry, for we are increasing $12.50. I don't like to increase the risk. I want to diminish the risk. So then that's it. I'm just not going to approve it. But I would like you to monitor this possibility, because notice how now, if the stock keeps going higher again, both below and above, you have the same risk profile, but now we have created a new zone there, okay, above, more or less what I said, 107 or something like that, where now you will be back in business, okay? You would have a profit zone there. So you are giving the trade a second chance nearer than the 117 mark, which is extremely unlikely that the market will rally to that level, okay? So I like the fact that I'm giving the trade a second chance closer to price, but I would only like this if I was to diminish the risk, okay? So I guess that you're gonna have to monitor and watch for that, okay? You're gonna have to monitor and watch for that. Certainly, we can bring in the skew tool and try to find strikes for the call that provide a little bit greater level of implied volatility. And play with the strike. So maybe you can do 105, 100. So I'm just going to do one test because I don't think it's going to work. And if it doesn't work, I'll stop here so we can focus on other trades. Exactly. So if I do 105 and 100, so now, again, I'm coming a bit closer to price, but I'm again increasing risk again from 230. Now I'm risking 295. So I don't want to do that. Okay. But monitor it, because again, if volatility, which is currently 43, let's say the market was to go crazy another couple of days. Let's say tomorrow the market opens gapping down 2%. And, and this is again falling hard. So then you can explore and do that. And probably what's going to happen is that this value will now become less than 230. And now you have this profit zone closer to price, giving the trade a second chance while you are diminishing the risk, which is certainly something I would welcome doing. But again, you need another push of implied volatility for this to work. And again, imagine already with going from 20 to 40, it didn't work because we are still creating, you can see the difference between the blue and the orange line. We are still creating more risk instead of diminishing the risk. Okay, it didn't work. So imagine if you did that when it was 30 or something like that. It would be a complete waste of time, which is my point before I started trying this, which is you would never do that. It would be a waste of time unless volatility has risen a lot. Okay, which was the case, but you see, not enough. Okay, so watch it and see if that works. Mark, Iron Butterfly, yes. Could you try an Iron Condor to widen the profit range? I just did. You read my mind, Mark. I love it because we are now thinking alike, isn't it? Little by little, through doing all those exercises of evolving positions from one thing to another one, doing all those tweaks, how I normally call them, right? It's little by little opening your thinking, to think this way. Okay, so that's great to see. Anyway, next one in line is Qualcomm, which again, Qualcomm, I don't have too much to comment. Okay, it's the same thing I did last week. So we already butterflied it. That stock has been moving lower significantly. So if I look at where we are, it's so much lower than what it was before. So again, not in a very good position. If we look at the options we are short, the ask price, it's 26.8 and 133. So closing those short options would not generate a profit because precisely implied volatility went higher so much. Even though we've been in this trade for a while, time decay has not offset the increase of implied volatility. So there is nothing to be done on this particular trade yet. And therefore, we're just going to wait, okay? And then we got EOG. Well, this one was a hedging stock, hedging trade. Again, after having that stock move against us significantly, the stock generated a nice push to the downside, which these kind of strong moves in the right direction, even though the stock moved in the opposite direction, those kind of strong moves are to be expected. Remember that the way we pick the stocks, either to go long or short, we always make sure they belong to either strong or weak groups. So we were not in the session that day, so I did nothing. So we are, kind of stuck on this trade. Same rationale as the LEN trade. So we're just gonna wait. But if you had done a conversion at this moment in time and you had butterflied it, you would be in a pretty good position. Actually, I would say probably you would have locked in a profit because when that drop took place, implied volatility, look at where implied volatility was compared to when we entered the trade. Okay, so you butterflying it with this excess of volatility very, very likely would have locked in a profit for you. Hopefully, and please feel free to comment. But hopefully, any one of you, someone in the group, you guys were watching for this or you were looking into it and you acted, okay, on this opportunity, because that would have basically brought this trade from negative P&L to locking in a profit or close to break even or something like that, okay? Anyway, I didn't because we were not in the session that day, right? And then FedEx is the last trade that we have here to review. I'm trying to do the review as quick as I can so we can move into new trades. Risk graph. So FedEx is an Aron Condor. We are currently here, okay, in the Condor. So we are showing a slight negative P&L of minus 37. This is where we are at the moment. But to be honest, from that angle, it's all good. We are in the green area, collecting time decay. So all of this is fine. Now, is it truly fine? Is it fine enough? Do we need to act on the trade? So let's take a look, because the way we manage those trades is by looking at our probability cone, isn't it? So we are using the cone, and if I go back in time to the day when we planned the trade, which I believe was here, okay? So our probability cone was looking like that, meaning that, the upper lines were here, meaning that the bottom lines were here and didn't cross any of the purple areas. So there was nothing to be done. As the market pushed very hard, and remember, the expiration date for this trade, it's on March 4, which is right here. I'm not sure why my box is not exactly well located. I'm not sure what I did wrong here. Okay, so here we go. My box should come all the way to here, which is March 4, which is the expiration date, right? So notice that here, we could see, okay, not on the prior day, okay, not on the prior day, but on that day when the market pushed very hard, we could see that the line went exactly where the purple line is, okay? So you may have acted that day, or maybe you were waiting to act on the next day, but guess what? On the next day, you had to act for sure because the market pushed again and you had a crossover, okay? So again, we were not in the session that day, okay? So we could not act together. Let me ask this question. If Christian, you are out and you are out of this trade and you made a profit of 16. Very, very well done. Very well done, Christian, on this trade management. Okay, that's the way to do it, my friends. That's why we spend so much time talking about trade management, because at the end of the year, if you get a few of the good trades that do what you want them to do, you get a few of the losing trades that don't do what you want them to do. But then you manage to turn around some of those trades that are not doing what you want them to do, and you turn them around into a much lesser loss or some sort of a profit. At the end of the year, it makes a massive difference in your account performance. So very good job there, and very proud to see that you guys are acting on your own. So fantastic. So anyway, on that day, okay, it was time to manage the trade, right? And so what would you need to do if that was the scenario, right? So obviously I was not there, so I didn't do it. But on that day, okay, the new expectation for the above range, okay, would not be this any longer. The new expectation for the range would be this. Okay? While the bottom part is now uh, showing a little bit of a pain, the upper part is showing a little bit of a profit from the call side, right? And what you would want to do now is you would want to find new UFOs here, right? And wherever they are, and let's say they are here, okay, blue line. So now you would take your call side, because up here you have a long call and a short. You have a long call and a short call, isn't it? Up there, long call and short call. So what you would want to do is replace them by a new long call and a new short call, align with this new value. Therefore, you would close the upper call for a profit and sell new calls which are nearer to the current price, and therefore collect more premium to defend yourself against a potential breach of the bottom area in your non-directional strategy. Okay, I didn't do it. I was not there, so I could not. But I just wanted to mention this as a review. Now, the day after, the market pushed even more, so obviously not too good. And now, if we move back to today, actually we are back, above this line, and therefore we are fine. Okay. Now, I missed it the other day. Today is not exactly the condition for us to do it because it needs to cross and it's not crossing. But if that's okay, just because I want to demonstrate how to do it, especially some of you are newer to the sessions, etc. So I'm going to pretend that this line is crossing over the purple line, and therefore I'm going to do what I just said it would be time to do, which is now moving this line here. Okay, so again, looking at where the maximum will be on the opposite end. Okay, and restart replanning your trade, doing the same thing that we did, which is to look at UFOs above that line. Okay, and we need at least two. Okay, so notice that we need at least two. We got plenty, way more than two, and it seems that a UFO that would be above this line would be located here, and this would be starting on today. So I'm just going to align it with a 2-day candle, so we know when this was drawn. Okay, so and if I go back to the daily time frame, okay, notice that I am now willing to instead of hold the calls up here, which is the 285 and the 280, I am now willing to close those calls for a profit and resell new calls around that 272 mark, because that's going to bring credit in to help the put side in case in the end that stock just collapses and crashes. Okay, and then we are in that problem. Okay, so let's do it. Okay, let's do it. Let's find out what's available and what happens if I do that. To do that, I'm just going to use the compare spread function. I'm going to copy the primary spread, and I'm going to be working on this one. Okay, but I'm just concerned maybe I'm moving a bit too fast to do this tweak. Could you guys please confirm to me that everybody's following? And if you're not following, let me know, please. So I'll have a little bit of a review so everybody follows, because this is important stuff. Okay, I need to make sure everybody follows. So let me know if everybody's there, and if you are okay, just tell me okay, so then I know you are okay, and that way, I can help better. So again, what's the first action to be taken? Close the call side to resell the call side lower. Okay, so let's first add 2 instructions to close the call side. So our calls is sell the 280 and buy the 285. So we're going to take the 280 call, we're going to take the 285, and we're going to reverse it, meaning that the 280 was a sell, we'll make it a buy. The 285 was a buy, we'll make it a sell, all of these with a midpoint. And when I click OK, this emulates, closing the call side. Okay, so notice now that because I close the call side, I am only left with the puts, and because I am only left with the puts, notice how this orange line, which is this is the second trade I am building here with the orange color. Notice how the orange line goes, horizontal. If the stock goes higher, I'll profit unlimited, not unlimited, sorry, unlimited when it comes to stock movement. The profit will be based on the credit collected, obviously. And then the blue line represents my iron condor, which means that if the stock was not to be in a range, but actually break out and keep going higher, then of course you will lose on the upper side, right? So in other words, what I've just done here is to emulate what if I close the call side. Okay, so now we need to look at what if we sell a new set of calls. Okay, and what happens? Before I do, let me take a look at the chat box. Okay, so it seems that everybody has been silent. Remember, guys, I really, really appreciate, even if it's all clear to you guys, that you guys confirm that it's all clear. If we are quick okay or something like that, it's really, really nice to receive. Believe me, especially when conducting a session online. Okay, if we were present in the same place, physically speaking, that's no need, because I would see you. But I really appreciate that if you can do that for me, guys. Thank you so much. Okay, so let's continue now. And remember that what we said is that we want to be selling options around 270 something, right? So the question is what's available, right? So I'm just going to add option leg, option leg. Again, it's all going to be calls. One is going to be a buy and one is going to be a sell. So let's see what's available. Okay, we got 280, 275, 270. Well, so it seems that the nearest to the 272 something, it's, I wish we could have the 272 and a half, but it's not available. The 270 may be a bit aggressive because the 270 is below the purple zone. So then what I'm going to do is I'm just going to try and see what happens if I do 275 sell and 280 buy. Okay, so buy the 280, sell the 275. Let's see how much this will help. Okay, click OK. Here we go. And here we can see that the amount of help that we generated, to be honest, is very, very minor, because now we move from an initial risk of 395 to a maximum risk of 384. So we reduce the risk by just a little bit. We also increase the profit by a little bit. Orange is above the blue, just a little bit of an increase. And of course, the break-even point above now is 275. Instead of 281. Okay, that is obvious. Okay, that is obvious because we are selling options which are nearer to price. But again, this is something that to me would not even justify the trade, especially because I can see that not all strikes are liquid enough. So 12, 43, 25, 56. So we're gonna suffer some slippage, and if we suffer some slippage, and in the end my result is just to shave or just $10 of risk, I'm not convinced to do that. So I'm going to have one last attempt, which is instead of doing 275 to 80, I'm going to do 275 to 70, which is a bit more on the aggressive side, but not that much aggressive. And let's see what happens if I do that. Okay, if I do that, so now my risk is diminished to 375, so it's a bit better. And my break-even above is 270.90, which that I'm not happy because my break-even is below the purple line. Okay, so if I'm using the 270 call, which is below the purple line, but my break-even point is above the purple line, so then I'm okay. But because my break-even point is not well located, so then I'm not happy with what I see. So now what's the issue here? Well, the issue probably is this: the fact that volatility is dropping. It's a good thing because the stock is coming back up, and if it comes back up, it's going to be centered in the range, and that's very good for the trade. But at the same time, it doesn't help me to tweak it as well. So again, if you did that in the prior days, you may have got a bit more implied volatility, especially if you did it right when the market gapped 2 days ago, I believe it was. So you would have got way more implied volatility, and this tweak would have helped much more significantly. But at this moment in time, I am not convinced to do the trade, also given the slippage I'm going to suffer. Okay, so no tweak. We're just going to go with it. If it happens tomorrow, the market crashes, and it's time to tweak. Remember, market crashing will bring volatility higher, so probably you will do this tweak, and it will provide a little bit of a greater improvement on the risk profile. But so far, we are not going to do it. It's too minor as a change in exchange for too much of slippage with those units. Cool. Thank you for that, Joe. Christian, why not rely on the red UFO to keep the pressure up? Um, oh, you mean this UFO here at 256 and just sell an option here? Is that what you're referring to? If that's okay, please confirm that when you have a moment, Christian, just to make sure I understood. Okay, I'll just wait to get your answer. I'll take a sip of water in the meantime. Again, as you can see, when we are doing tweaks to our trades, when we are evolving, because options give you options, right? Well, precisely because options give you options, every option chain is different. Every expiration date is different. Sometimes it's $5 of strike price increments. Sometimes it's $2.50. Sometimes it's $1. Sometimes it's good pricing. Sometimes it's slippage. So you need to have those principles clear in your mind of what is it that you're trying to do. But also you need to be ready to sometimes accept the tweak and sometimes reject the tweak. It's not black or white. It's not like I go long now, I go short now, or I hit my stop, I hit my target, that's it. So when you are doing those tweaks, you need to overlay on top of your plan and your rules common sense. In this case, common sense, which suggests that, saving $12 of risk in exchange for potential additional slippage, makes no sense. Okay, so I will not do it. Okay, get your answer, Christian. Okay, so here's why I would not do that. First, this trade is a trade that was identified using certain technical parameters, such as the strength using the matrix on the weekly and the daily time frame as neutral. Of course, the stock has moved aggressively, but why is that? Because the S&P has moved aggressively. So it's not like that stock is a very good directional bet, that belongs to a very strong group or very weak group. We didn't look for parameters of that sort. We didn't look for groupings. We didn't look for climate. And we actually filtered for neutral strength on the daily and the weekly. So let's say on the daily showing speed, well, maybe if we switch this to weekly, you may realize that it's not that strong. Okay. Okay. Interesting. Anyway, so my point is, keep in mind that technically speaking, that stock has a neutral component in it. We're now betting very hard on a direction. While it makes sense in the sense that short term the trend is down and everything else, remember in a larger time frame we had a neutral component, and you may be very disappointed that the stock, while it's fell very strong in a few days, now basically does nothing. And if you are too aggressive with selling calls to close, next thing you know, you may get price movement to hurt you. And why am I saying that? Well, because two reasons more, right? So if you look at the extreme of that UFO and you look at the fact that we are using expiration dates that expire in March 4, well, forget about UFOs for a moment. Statistically speaking, you can reach up to this point, which is far above where the UFO is. So if suddenly you become aggressively directional on a stock that got a neutral component built in, technically speaking, that we scan for, and on top of that, you are using a UFO which is so near, you may end up having the stock move against you significantly, even if the stock is behaving neutral. These are a statistical possibility for price movement. So that's a problem. And that's reason number one why I'm not too happy about it. But the reason number two, which is even more important, it's look at your climate. So while your climate is red, it's candle 12 out of 9. We reached 169 out of 144. That's actually okay. I read that backwards for a moment. So 144 is the maximum we reached. where 169 is two standard deviations of too far too fast. So that stock didn't move too far too fast, which, by the way, I'm not surprised in the sense that there is a neutral component built in that stock, isn't it? We scan for it. But in any case, from a duration of the climate point of view, that climate, it's more exhausted than a healthy climate for us to bet on a downside move. So relying too heavily on that UFO, well, it may work because it's a UFO. The odds of it to be working are not that great. So again, um, unless you have different type of rules in your plan, and then it would be fine. Because in the end, remember, we cannot predict the future. So it's all about acting rule-based, having a mechanical approach to trading, and of course, an approach that gives you odds, right? So unless you have a certain plan or you're looking at certain parameters, which I'm not discussing now, which, I'm sure there is a way to, look at this in a certain way. Remember what I told you about, if you keep looking, you will find contradictions, right? Because every time frame will give you a different indication. So unless you have certain rules that tell you that to you is fine to do that, and you do it consistently with all your trades, so then fine. But if you were to apply the rationale I just expressed, so I guess now you are with me on why is it that I'm not thinking to use that UFO, and instead I will be relying on this purple line above, which also has UFOs, but those UFOs were further out. And therefore now I'm comfortable given what I'm expecting from that stock to do, given its neutral component. So long conversation, but again, very, very important conversation, and very, very good question. Christian, I really appreciate it that you're asking such advanced questions. Shows a lot the trading that you're doing, the practice, the time and effort that you put in place, and indeed, very helpful for many of the attendees, many of the viewers, many of of you guys in our community. So thank you so much for sharing those thoughts. Cool. Okay. So wow, I'm just looking at the time. We are four minutes away from the top of the hour, so we're not gonna be able to do too much, isn't it? Let me try to see if we can identify some sort of a trade. Again, remember I said we will look at non-directional opportunities, right? So let me see if we can find something. So at least, I'm not sure I'm going to have time to plan a trade, but at least giving you some homework, maybe that could be a good idea. So we have a few stocks that seem to be providing opportunities, okay? So let me take a look. Let me take a look at Baidu. Okay. Let me take a look at Baidu earnings. February something, so we can use February 11. This is 2 weeks from now, so I can use February 4 or February 11. So let's try to do this very quick with Baidu. Okay, so Baidu, we're going to use February 4 and 11. We're going to be looking at short iron condors. Okay. Let me float this and maximize it. Okay, great. So this is a $146 stock. So I'm going to go from 1 to 2. That's fine. Okay, I want to create 99, activate my filter and load the template. I am indeed flying now, guys. Okay, so I hope you understand given the time. Okay, yeah, no trade is meeting the conditions that we have for iron condors in the case of Baidu, which is surprising, to be honest. Which is surprising. Okay, what's the next one in the list? Next one in the list, I'm gonna pick JD. Okay, so JD earnings on 310. Too many expirations here, so let me take a look at and see if we have any equal advantage with any. So 310 means that I could go all the way to March 4. So February 4, 11. Okay, so it seems that March 4 would be more convenient compared to February 25. So I'll ignore 25. I'll ignore 25, and the other ones seem to be quite normal. Okay, so I'll ignore 25. Okay, so let's go for JD. I'll give it a try. If it doesn't work, I guess that would be it. Okay, so I'm going to use 4 different expiration dates. This is a $67 stock, so 1 to 2 will be fine. Okay, let me see if we have some passes. Okay, so with February 4, we have some passes. Let's take a look at February 4 when it comes to. Actually, I'm not very happy to see this, my friends. I should have looked at this before. Historic volatility, we got 3 blue lines above the red line, which tells me that the speed of movement of the stock is way faster than the premiums we can find in the options. I mean, the options are indeed in the 80%, range. So options are not cheap, but I would like to see a bit more spice. At least, one of the blue lines outside is fine, but 3 of the blue lines outside makes me feel that we may not collect enough premium, and in the end we do the whole exercise and then we don't get a yes. So with that and the fact that we reached the top of the hour, so I'll just stop the session here, guys. Lots of discussion on position maintenance and tweaking those trades, to readapt to market conditions during the life of a trade. Indeed, very powerful concepts and tools. We had a great example today with Christian and the trade with EOG that was totally moving against us. But next thing you know, just because of a one-day move, that was impressive, I have to say. But just because of a one-day move and volatility going higher, next thing you know, the trade ended up in a profitable status where it should have been 100% a trade meeting the maximum risk criteria. Instead, the trade was a profit. So that's very, very nice to see. And indeed, hopefully, if you are new to the sessions, you understand the beauty of options from that angle and the power of learning these tweaking skills. So anyway, my friends, we are done for today. Thank you very much for joining me. I will see you in the next session very soon. And in the meantime, keep up the good work. Thank you for the comments, the questions, the sharing, hard work, and always a pleasure. It's always a little bit of a special time for me to run the session. So thank you for being part of it, and see you soon. You guys take care.